Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to cover part 2 of the 30 Dow Jones Industrial Average constituents, and I'm going to look at 6 more expensive Dow stocks. With the second group of companies, I'm going to look at Microsoft, 3M, Coca-Cola, Nike, Procter Gamble, and Home Depot. I currently have them listed in order of highest credit rating to lowest, but the thing I want to point out is these are all extremely high quality investment grade companies. We have one Infotech, 2 consumer staples, 2 consumer discretionary, and 3M is considered an industrial. When I organize this list by order of highest to lowest PE ratio, you'll see that 3M comes in at the highest and Nike comes in at the lowest PE ratio. And I do want to point out all of them have earnings yields that are lower than my personal threshold of 6.5% to 7%. These low earnings yields to me is another indicator of overvaluation, if you will. The first thing I'm going to do is take a look at all of these 6 constituents based on their operating earning history alone. I've taken the price, dividends, normal PE ratio. All I have here is the plotting of the company's earnings per share going back to 1998 in most cases, depending on the fiscal year. Home Depot has a January fiscal year end. What's interesting about this is you look at Home Depot, you see a period starting in 1998 of very excellent and consistent growth. Then as we came into the Great Recession, we saw 3 or 4 years of actual negative earnings growth, and then that was followed by a massive acceleration in earnings. I think this is very important when we start looking at the price. So what we see here is an excellent growth stock with just one period of interruption in the middle. When I look at Coca-Cola from the same perspective, only looking at the company's earnings, I get a very interesting picture here. I see some decent growth between the 2 recessions, but I want you to notice that in recent years, Coca-Cola's earnings have been very flat. If I run this just over the last 5 or 6 years, and this includes estimate data here, you'll see that Coca-Cola's earnings growth rate is only 1.2%. And clearly this company's growth has slowed down, and that's an important consideration when you're considering investing in the company. My next example is 3M, one of the more consistent performers of the group here. You can see that earnings growth has been steadily upward, averaging about 6%. But if I call out this down year or take out this down year or two, that earnings growth goes up to about 9%. So a 7 to 9% growth rate on 3M, I would consider a very reasonable assumption. The next example, I'm going to look at Microsoft, and I think Microsoft has some very interesting attributes here. It is a tech stock. There's a moderate amount of cyclicality, but there's also a significant amount of growth. You can see a down year during the recession, but I want you to notice the stock stayed highly profitable, had 2 great years just coming out of the recession, and then we had about 5 flat years here, and now Microsoft is considered to grow again. I think you'll find it very interesting to see how that affected Microsoft's stock price. With my next example, I'm going to take a look at Nike, and Nike again is a very consistent grower. I'm going to cut out the one down year. Its average earnings growth has been about 13.5%. The only real blemish on Nike's record here is that analysts are expecting about an 8% drop in earnings for this fiscal year, which ended May 31st, and they'll be reporting. Usually takes about 45 days after the fiscal year end for the company to report. So then finally, we're going to take a look at Procter Gamble, the 6th constituent here. And similar to what we saw earlier, you're looking at a company that had some pretty good growth going forward. And then notice that the earnings growth rate has been very flat in recent years. This, to me, reminds me very much of what we saw with Coca-Cola. Now, analysts are forecasting some rather strong growth going forward, but I want to cut out the earnings estimates on this graph here and just look at Procter & Gamble from the standpoint of what it's actually achieved through June of this year, which is the 2017 fiscal year. If I look at just the last 7 years of earnings growth from 2011 through 2016, you can see that the company's virtually had no growth. It's averaged less than 1% a year. Again, an important consideration when you're looking at and examining these companies. Now, going back to Home Depot, I'm going to start adding some features to these stocks in addition to just earnings. I'm going to add a plotting of dividends. As you can see, dividends per share for Home Depot have consistently grown. This area below the white dividend line represents the portion of total earnings that are paid out to shareholders in the form of dividends, and then once those dividends are paid out, we plot them on top of the fast graph. But the most interesting aspect now is to finally bring in the monthly closing stock price. And we see some very interesting relationships here with Home Depot. We see this irrational, exuberant period where Home Depot got extremely overvalued. We saw very poor stock performance for the next 3 years or so, even though earnings per share were actually growing at a very high rate, 40%, 10, 17, 21. Then we saw Home Depot's stock price track its earnings very nicely, but then we begin to see a separation starting in 2011. However, this is somewhat of a visual illusion, because if you go down and just look at the last 7 or 8 years of Home Depot's earnings growth, you will see that the earnings growth has accelerated to over 18% a year, and so Home Depot's stock price probably makes more sense there. And then finally, if I add the normal PE ratio, you'll see that since 2012, Home Depot's traded about 20 to 22 times earnings. The normal PE is 20.9, 21 we'll call it. And so you can see that it's trading at a moderate premium to even that higher valuation. Moving on to the next example, and I'm going to leave the graphs together now since you've seen them. I'm going to take a look at Coca-Cola, and here once again you see a very interesting relationship between price and earnings. In this case, I want you to notice a very high normal PE ratio, which is obviously affected by these very high PEs that Coca-Cola was selling at back in 98 and 99. I dropped this to a more reasonable time frame. You see a normal PE of about 20, 19.7 is the actual calculation. And that's been a normal price-earnings ratio for Coke. I want you to notice that as their earnings have flattened, their payout ratio, the portion of total earnings they're paying out in dividends, has increased dramatically, as you can see down here by the numbers. And that is as much a factor of the fact that earnings are flattened, but the company continues to have a policy of increasing their dividends, or attempting to increase their dividends. Now, what's interesting is when you look at Coca-Cola from a standpoint of operating cash flows, which has a higher yielding 3.3% dividend yielding company, you get a slightly different perspective of valuation. There's a higher correlation between price and operating cash flow. However, operating cash flows have been weak last year and expected to be weak again this year. That's something that I believe prospective investors should take into consideration. As I move on to 3M, this is another case of a company that commands a premium valuation generally by the marketplace. But even today, you can see that with its normal PE ratio of 20, as you can see, it's traded around that. It's significantly above that now. So clearly, relative to historical norms at least, 3M is overvalued relative to its earnings history. When I switch this to operating cash flow, again, because this is a dividend paying stock and a blue chip AA rated dividend paying stock, we see a much clearer correlation of price to earnings. The Great Recession created a significant period of undervaluation, which really led to some really good stock performance over the next 3 or 4 years. But now, as it relates to operating cash flow, we have 3M trading at a very high valuation. This would imply that if the stock in the near term would move back into a more normal 14 or 15 times operating cash flow, you could see up to a 13% drop over the next year or two in the stock value. That to me is the short-term risk associated with investing at a high valuation. If I move on to Microsoft, I'm going to leave the operating cash flow up here because Microsoft has one of the lowest prices to operating cash flow of any of this group. And once again, as you kind of change the time frames here, you see that an 11 or 12 times operating cash flow has been a very accurate valuation metric for Microsoft going forward. So even though its price to cash flow is relatively low, it's trading higher than its normal price to cash flow. Now, the graph gets very interesting on Microsoft when you look at it from an operating earnings point of view, because from an operating earnings point of view, and I'll go ahead and expand it to the all graph, you can clearly see this ridiculous tech bubble that we had and very almost no performance, negative performance for many, many years, even though Microsoft's earnings growth was actually pretty decent. The price was just so ridiculously overvalued, we had nowhere to go. Just picking any spots in here, not tops and bottoms, you can see that this was a negative 5% compounded annualized rate of return for many years here during this period. Then we see as earnings as we went through the recession, the price got below the earnings line, and it stayed below that for 2 or 3 years. And now all of a sudden we've had this resurgence, if you will, in Microsoft's stock price. But clearly on an operating basis, this stock is significantly overvalued relative to historical norms. When I move on to Nike, you'll also see another situation here where Nike's stock price has gotten significantly above its earnings justified value. However, if you look at a normal PE ratio, it's trading closer to how the market has liked to buy that. But I want to point something out here. Even though this is a reasonably correct calculation that Nike often trades at 22 times earnings, I also want you to notice how often it trades below 22 times earnings. In other words, I would call this fully valued, maybe perhaps more than overvalued, but I don't think there's a bargain in Nike today at these levels. And of course, the earnings correction did cause the price correction that we saw there on the graph. Finally, as I go to Procter Gamble, we see another interesting example here of a company who trades at a premium to earnings. When I look at Procter & Gamble based on operating cash flows instead of earnings, and I've got several other metrics I can examine all these stocks with, I see again a much more correlated, like we did before with Coca-Cola and 3M, a very highly correlated price to operating cash flow at about 15, but it currently trades at 18. Part of that is because cash flows are expected to drop and stock prices held up, but nevertheless, I would consider Procter & Gamble very expensive at these rates. And I would also like to point out that this company has had virtually no growth over the last couple of years. And there's a pretty interesting article in today's Wall Street Journal about Procter & Gamble. Anyway, this is a quick review of the relative valuation of these 6 additional expensive Dow stocks. I hope this gave you some additional insights into what these Dow stocks actually look like and how the markets historically valued them. This has been Chuck Carnevale saying thanks for listening.